Our team analysed 8,771 suburbs within Queensland and found there is somewhere between 200 to 300 suburbs where we would not invest right now. Hello, property navigators. I'm making this video because tens of thousands of you have watched our other videos where we've recommended specific regions to consider buying within southeast Queensland. Because we recommend a region does not mean that you should just go and buy any property there in any suburb. I can't be clearer on that. This video will show you that not all suburbs are equal. To demonstrate this for you, I started compiling a list of southeast Queensland suburbs where we suggest to not buy right now. I started off looking to find 10 suburbs, then that grew to 100, and even that rapidly grew to hundreds. And knowing how quickly markets move, even that will have changed by the time this video gets released. So instead of ragging out on Brisbane's worst 5 suburbs and telling you where not to invest, I thought to explain how this stuff gets figured out and show you ways you can keep an eye on that too. I'll give you a downloadable list at the end with about 150 to 200 of these suburbs on it. Let's get going. So how is this stuff worked out? For the purposes of this video, we're going to rely on what is called a capital growth score. Now, this score is determined by assessing a number of factors relating to each suburb and local government area to determine how likely it is to perform in the next 0 to 5 years. This is calculated using over 80 metrics with a subset of the most impactful metrics now on screen. To keep this explanation somewhat simple, each of these 80 data points means something unique in terms of the supply, demand, livability, and appeal, etc. of a regional suburb. While analysing this data is important, it is just as important how the data is correlated to one another. So each data point has a different assigned weighting, as does the correlation of how they interact. Now, there are algorithms out there that do this, and there's some really cool software out there too. Or Boyd's brain's really good at it. Either way, what you need to know is that there is a lot of advanced learning that goes into the analysis and correlation of data. Our team used a data tool that analysed 8,771 suburbs within Queensland. We then narrowed that list down to analyse just the suburbs in southeast Queensland with the lowest scorings. Now, this is not a complete list, but a list of the lowest scoring suburbs as per when this video was created. One familiar theme across each of these suburbs is that they are all in a consolidation phase of the property cycle. We have a whole video on property market cycles and the phases within market cycles, which is a fascinating topic, and the link's just down in the description. The consolidation phase within the property market cycle is a critical period that typically follows a boom phase and precedes a recovery or growth phase. During this time, the market stabilizes after experiencing rapid growth and high prices. Market activity slows down, prices plateau, and the market absorbs the excess from the previous boom. One key distinction across all of these markets we're showing you today is that each will be in its own distinct point of the consolidation phase. Some have just entered and others will have been in for longer and might be exiting. They are all not in the exact same point of the phase, and I'll explain soon how you can tell. One key characteristic of the consolidation phase is the stabilization of prices. Property prices generally stop rising and may slightly decrease or remain stagnant, correcting any overvaluations that occurred during the boom. Additionally, there is a noticeable drop in the number of property transactions as buyer and seller activity slows down. Investors and buyers become more cautious, leading to a lower turnover rate. The number of properties listed for sale often increases as sellers who missed the boom phase attempt to sell, resulting in higher levels of unsold inventory and longer days on market. The causes of the consolidation phase can be attributed to market saturation, where demand diminishes as prices become unaffordable for many buyers after a prolonged period of rapid growth. Broader economic conditions such as rising interest rates, economic slowdowns, or changes in employment rates can also contribute to the onset of consolidation. It's such a unique period that you can't umbrella with just one reason for the causation. This phase represents both opportunities and risks. Savvy investors and buyers can find good deals as prices stabilize or slightly decrease. However, there is also a risk of property prices declining further depending on what point of the phase the market is in. The consolidation phase is an essential part of the property market cycle, providing a necessary period of adjustment after rapid growth. It also allows the market to stabilize, absorb excess inventory, and correct the previous rapid increases in prices. This may lead to a more stable and sustainable market and set up that location for the next boom phase. But again, multiple factors will play into the strength and direction of this movement. Now, you need to keep in mind that the data used here is live and changes not just every month, but literally every day. So this list I've compiled can and will change. Heck, I'm 100% sure some of these suburbs will have moved out of the consolidation phase and others would have moved into theirs since I put this list together. Let's dive into the data and take a look at one of these markets and compare it to a market we have analysed in our previous videos. Let's look at the Moreton Bay region and compare Bray Park and Redcliffe. Now, these two suburbs are in the same LGA and have pretty closely the same population, with Bray Park at 10,246 and Redcliffe at 10,373. This is an important comparison marker, as if one suburb has half the population of another, well, you'll be pretty sure that more properties will be listed at any one time because there are literally double the amount of people living there. A higher inventory of units in a suburb can also skew the number of properties sold, and I believe Redcliffe does have more than Bray Park does, but for all intents and purposes, this will still keep you on the right track. Looking at the long-term market trend data, we can see that in 2020, Redcliffe's median value was $446,650 and Bray's Park was $425,065, so just a tad over a $20,000 variance, equating to a 4.95 difference in the median price. In the 4.5 years 2020 to mid-2024, Redcliffe had 71.8% median price growth, while Bray Park experienced 62.1%. Now, this difference in median price growth increased the difference between the two suburbs' median prices from 4.95% in 2020 to 12.93% in mid-2024, an almost 8% increase in the difference. This could show us that Redcliffe was on its own point of its boom phase over this time period compared to Bray Park. Redcliffe certainly did win the race, but let's have a more granular look into the more recent data. We can see when we compare the two suburbs' recent market trend data, there is a huge difference on the stats over just the last month. Compare the number of listing and days on market levels and you can see how much quicker properties are now selling in Bray Park and how much less stock there is on market, because it is selling in literally half the time, as you can see from the days on market metric. We are talking double-figure differences here. Growth has picked up in Bray Park too. Look at that, it's now overtaken Redcliffe by over double figures. Rents are also trending upwards, so you can see how Bray Park has heated up recently while Redcliffe has really cooled down. This is market cycles and the phases within them at work. I want to also very importantly note that RP data is providing lag data here. As you can see, only up until March 2024, where the last upturn in median value was 3.9% in Bray Park, but just 1.6% in Redcliffe. And this is the thing with lag data. There is a 3-month delay in what you can access, so you'll never be right on top of things. That's why as buyers agents, we have to be on top of the areas we specialize in. And a lot of our up-to-the-minute insight comes from buying in our areas each week. So we know what's happening price-wise in those areas. That's what boots on the ground research is all about. Knowing what a property sold for yesterday, not just last month or the month before. Now, we are not saying that if you bought in Redcliffe right now that you'd lose all your money. Not at all. This is a simple comparison to show that there may be better markets to invest with much better short-term outlooks for you to return your investment sooner. Lastly, there's a link in the description for you to download this list of suburbs I've put together for you. But remember, it is a reference only, and I'll put the date that the data was prepared in the document. So make sure you check that, because it will be useless to you if you're watching this video months after the published date of the document. By the time you watch this video, there will be suburbs on our list that may have moved out of their consolidation phase and others that will have moved into theirs. That's just how the property market works. Now, if you want to know about the specifics of a market you're looking to invest in, give us a buzz and book one of our free discovery calls and we can run through this data with you. Until next time, happy property navigating.